You've spent 30 years building your retirement savings. You've had decades of maxing contributions. You're ignoring the noise. You're riding out the rough patches because you knew that intellectually markets recover. You've been patient. You've been disciplined. And now you're in your 60s ready to retire. Maybe you're 3 years from making that decision. Maybe you've just crossed the finish line. And the market is now dropping hard. Your balance is down 20, maybe 25%. And the voice in your head, the one that sounds suspiciously like wisdom, is whispering, what if this time is different? What if you just get out, wait for the dust to settle, and get back when things calm down? I get it. That voice does not feel like panic. It feels like you're protecting yourself. It feels like prudence. But today I'm going to show you, using actual published research, decades of market data, and the behavioral science behind why our brains betray us during volatility, exactly why acting on that voice is one of the most financially damning mistakes that a pre-retiree can make. And more importantly, I want to walk you through something that is real to you. It's going to be evidence that actually says what you should do instead. My name is Jake Landau. I'm a certified financial planning professional, and I've been helping families retire with confidence and clarity for over a decade at Vanguard and Schwab before launching my own firm. Let's start with the foundation of what we're talking about today, the market's long-term track record. I know that you've heard stay the course, especially if you're a boglehead like myself. You've heard the message before. And I know it can kind of feel hollow when your portfolio is actually losing money in real time. So I want to go deeper than platitudes here. I want you to understand not just that markets recover, but how consistently they have and across how many genuine crises. Since 1950, the S&P 500 has experienced 13 bear markets, meaning declines of 20% or more. And according to research compiled from Morningstar and market historians, across those 13 events, the average peak to trough decline was approximately 33%, and the average duration was around 338 days, roughly 11 months. Think about that for a second. The average bear market, not the mild ones, the full 20+ declines, lasted less than a year. And every single one of those ended. Every single one was followed by a recovery that went on to new highs. Let's look at the two most recent major ones in detail because I think specifics here matter more than the averages. The S&P 500 peaked in October 2007, and from that peak to the bottom of March 2009, the index fell 57%. That is a devastating number. If you had $1 million portfolio at the time, you watched it become $430,000. Lehman Brothers collapsed. AIG required a government bailout. There were serious, credible economists on television saying that the global financial system might not survive this event. The people who sold in the fall of 2008 or early 2009, right at the moment of maximum fear, locked in those losses permanently. What happened next, as I think we all know? The market bottomed on March 9, 2009. And from that point, the recovery began what would become the longest bull market in US history. By 2013, the S&P had fully recovered its losses, and by the time COVID hit in 2020, it had roughly tripled from its 2009 bottom. Now here's the case study that I find remarkable precisely because of the speed of it happening. In COVID, the S&P 500 peaked on February 19, 2020, and by March 23rd, just 33 calendar days later, it had fallen 34%. That is the fastest bear market in recorded history. Think about what that 33-day window felt like. There was a global pandemic. There were lockdowns across every single country. Entire industries were shutting down overnight, and there was a genuine medical emergency with no clear endpoint. And then, almost immediately, the recovery began. By August of that same year, 5 months after the trough, the S&P had fully recovered all of its losses. By the end of 2020, despite a global pandemic that was still very much ongoing, the index finished 18% up. That is the fastest recovery from a major bear market in the last 150 years of market history. Here's a number that I want to leave on screen for a moment because it is that important. According to data that's tracking the S&P 500 composite going back to 1926, $1 at that time, at the beginning of 1926, with dividends reinvested, would be approximately $20,000 today. That dollar that you invested in 1926, that is now $20,000 today, lived through the Great Depression, the Korean War, stagflation, World War II, Black Monday in 1987. The Dow fell 22.6% in a single day at that time. The dot-com crash, which took the NASDAQ down 78%. The 2008 financial crisis, COVID, all of it. There is no better long-term evidence that we have than this record of that dollar. The market has, without exception, recovered, and the investors who stayed invested have been rewarded. Now, is this a guarantee? Absolutely not. Past performance does not guarantee future results. I will always be honest with you about that. But it is the most comprehensive evidence available, and that evidence points clearly in one direction. One observation worth making here, I think, is that the Great Depression recovery took decades, but that was also accompanied by catastrophic policy failures. The Smoot-Hawley tariffs, bank failures with no FDIC insurance, a Federal Reserve that contracted the money supply. The reality is that because of those events, institutional and regulatory infrastructure of modern markets is just categorically different. The more recent data, every bear market since 1950, shows a much more consistent pattern of recovery within a matter of years and not decades. Now, if we know all this and we have the history and evidence to go back, and it's clear and consistent, why do intelligent, well-informed people still sell in panic? This is not a stupidity problem. It is a wiring problem of our brains, and it's worth understanding the actual science behind it. In 1979, psychologists Daniel Kahneman and Amos Tversky published what would become one of the most cited papers in the history of economics, a study called Prospect Theory and Analysis of Decision Under Risk. Their central finding, which Kahneman would later win the Nobel Prize in economics for in 2002, is something called loss aversion. And here's the key of what loss aversion is. The pain of losing money is psychologically about twice as powerful as the pleasure of gaining the equivalent amount. And what that means in practice for you is that a 20% portfolio decline doesn't just feel bad, it feels approximately as bad as a 40% gain would feel good. The asymmetry here is real, it is measurable, and critically, it doesn't go away just because you know about it and I'm telling you about it and you're reading the report and the evidence. That is why watching your portfolio drop $200,000 produces a qualitatively different emotional response than watching it rise by $200,000. It's not irrational exactly because it is deeply human, but it does become destructive when that emotional response drives a financial decision. A 2019 global study published in Nature Human Behavior, replicating this exact original finding across 19 countries and 13 languages, found that the framework for loss aversion replicated 90% of the time in scenarios tested. So this is not a Western quirk or a dated finding. It is a near universal feature of human psychology that is not going away. Here's a second factor that compounds the biological one that we have. When markets fall, news coverage of that market intensifies because headlines get more alarming, you're coming back to them, you're spending more time looking at their advertisements. Your social media feed is filled with catastrophizing. Every single pundit gets airtime to explain why this time is different and why you should be very scared. The sheer volume of negative financial information that you're exposed to during a downturn is dramatically higher than your exposure to positive information during normal or recovering markets. This is not, by the way, a media conspiracy. It's just how the news cycle works. Crises generate attention, but the effect on investor behavior is very real. Your brain is processing loss aversion signals while simultaneously being flooded with confirming negative information. The wonder isn't that some people do panic sell, it's a wonder that more people don't. There's a third psychological factor that I want to name directly because it's specifically relevant to where you are if you're between the ages of 55 and 70. Every major market downturn comes with a compelling narrative for why this specific one is uniquely catastrophic and therefore warrants a different response from before. In 2008, it was the collapse of the global financial system. In 2020, it was a once-in-a-century pandemic. Those were all genuinely serious events. The narratives were not fabricated. But the conclusion people drew, that this particular crisis would break the historical pattern of recovery, was wrong every single time. The very thing that makes a crisis feel different is the same thing that makes you most tempted to act. And it's worth building your decision-making framework around this recognition of what's happening in your brain and what you're ingesting as information. Now, I want to get concrete about the actual costs of panic selling because I think the numbers are actually more alarming than people realize. When you sell out of your portfolio during a downturn, you're not just making one decision, you're making two. You're deciding to get out, that's the first one, and you're committing now to a future decision about when to get back in. Now, here's the problem with that. The second decision, if anything, is actually harder than the first because the conditions that will make you feel safe enough to re-enter the market are also the conditions under which markets have already recovered significantly. The market bottomed on March 23rd. Would you have felt safe re-entering on March 24th? The pandemic was still accelerating. There was no vaccine available. There was no clear timeline on when industries or people would get back to work. The answer to most people is no. By the time the news felt safe to re-enter by August, when the recovery had been confirmed, you would have missed most of the gains. And this is not a hypothetical. This is why I talk about staying in the market being just as important as getting invested in the first place. According to research from JP Morgan Asset Management, if you had invested $10,000 in the S&P 500 in January of 2005 and left it just untouched through the end of 2024, you'd have accumulated approximately $72,000 for an annualized return of roughly 10.5%. If you now missed the best 10 trading days over that same period, your portfolio would be $32,871, less than half of that. Now, here's what makes that so striking, because the same research says 7 of the 10 best trading days over the past 20 years occurred within a 15-day time frame of the 10 worst trading days. The biggest up days and the biggest down days cluster together and happen within the same windows of volatility. If you're sitting in cash during the scariest parts of the bear market, you are almost certainly also sitting in cash during its sharpest recoveries. I want to add another piece here because every year since 1994, a research firm called DALBAR has published what it calls the Quantitative Analysis of Investor Behavior. It tracks the actual returns that the average equity fund investor earns versus what the S&P 500 returns. The results are consistently sobering, and you should be thinking about this again. Over the 30-year period from 1994 through 2023, the S&P 500 returned an average of 10.15% per year. The average equity fund investor earned 8% per year. That is a gap of over 2 percentage points every single year for 30 years. Now, that might sound small, but let me show you why it is not. On a portfolio of $500,000 over 30 years, the difference between 10.15% and 8% compounded annually is more than $1.5 million. The gap is almost entirely attributable to behavior decisions, buying after markets have already risen and selling after they've already fallen. In 2024, according to the same research in their most recent report, the gap had actually widened significantly. The S&P 500 returned 25% that year, and the average equity fund investor returned just 16.5%, an 8.5% underperformance in a roaring bull market, because investors were pulling money out ahead of major rallies and re-entering too late. The data here, I just have to say, is not ambiguous. Attempting to time the market costs most investors, not just some investors, not just unsophisticated investors, a measurable portion and a significant portion of their long-term returns are lost by trying to get out and get in at the right time. Now, I want to address the legitimate concern that sits underneath kind of all of this panic selling impulse, because if you're someone that is about to retire or have just retired and you're worried about a bear market, you're not just worried about the abstract portfolio values. You are worried about something that is very real, and that something has a name that I want to put to today. It is called sequence of returns risk. Now, sequence of returns risk refers to the danger that poor market returns early on in your retirement during the period when you're actively drawing down from your portfolio can permanently damage your financial plan in a way that later good returns can't fully repair. This is not a theoretical risk. It is one of the most important concepts in retirement income planning, and it works differently from anything that you've probably experienced during your accumulation years because, just putting it bluntly, this is a different financial phase of your life. Now, let me give you a clear example and what this looks like as an illustration. So imagine you have two retirees. We'll call them Margaret and David. Both retire in the same year with $1 million, and both plan to withdraw $50,000 per year from their portfolio, adjusted for inflation. Now, both of these people will return an identical average over a 30-year period, let's say 7%. The only difference here is that Margaret retires into a bull market and David retires into a bear market. After the first 3 years, Margaret's portfolio has grown significantly despite her withdrawals. Her balance is strong and her future withdrawals represent a very manageable percentage of the larger base. Now, David, in those same 3 years, is withdrawing $50,000 per year from the portfolio, but it is simultaneously falling here. To raise that $50,000, he's forced to sell shares at lower prices. Every share that he has to sell at a discount is a share that's not there when the recovery happens. His portfolio now is on a steeper downward trajectory even before the recoveries in the markets begin. By the time that both portfolios experience the same average return throughout the 30 years, David's situation may be fundamentally compromised in a way that's very difficult to reverse. This is the sequence of returns problem in its clearest form. The order of your returns matters enormously when you're withdrawing, not just the average. Okay, so here is why this specifically affects people in your window, people that are 5 to 10 years on either side of retirement. When you're 35 years old, a 30% market decline is painful on paper, but it is a buying opportunity in practice. You are contributing still to your portfolio. You're accumulating shares at lower prices. Time is on your side in an almost unlimited way. But when you're 63, the math changes. Your portfolio balance is likely at or near its lifetime peak, and meaning the absolute dollar amount of a percentage decline is maximized. A 30% decline on $200,000 costs you $60,000. A 30% decline on $1.2 million costs you $360,000. It is a very different reality. And critically, if you're already in retirement, you don't have the option to wait it out to recover the same way that younger investors can. You need income, which means you need to sell potentially into a down market. The concern about sequence of returns risk is legitimate. I'm not going to dismiss it. It is real, it is important, and it is the right thing for you to be thinking about if you're on either side of retirement. But panic selling is not the answer, and here's why it actually gets you closer to the worst version of the problem. If you sell a portion of your equity portfolio during a bear market, you have locked in your losses at depressed prices. You have converted your investments to cash, which earns very little. You have begun drawing down cash while the market recovers without you, and when you do re-enter, it will be at higher prices than when you sold. You have not protected yourself from sequence of returns risk. You have actually insured it. You've done the one thing that turns a potential bad outcome into a certain one. The actual research on managing sequence of returns risk points to a set of strategies that have nothing to do with market timing, which I actually think is optimistic because it's everything to do with something that's in your power and based on your financial plan. The most direct defense against sequence of returns risk is ensuring that you're never a forced seller of equities during a downturn. From academic work by Wade Pfau at the American College to the practical frameworks used by financial planners across the industry, consistently points to holding somewhere between 1 to 3 years of living expenses in cash or short-term, very liquid assets outside of your equity portfolio. Now, why does this work? Well, because most bear markets, based on historical data, resolve within that 1 to 3 year window. We know that if you have 2 years of spending needs in a money market or short-term bond position, you can leave your equity portfolio alone. You don't need to worry about what the price is on a day-to-day basis. You are never forced to sell at depressed prices. Your equities stay invested and they participate in the recovery. You might hear this called the bucket strategy, and while there are various ways to implement it, The core logic is pretty simple. It is just to separate your short-term income needs from your long-term growth assets that the market volatility does not create forced liquidation. The point is that thoughtful, evidence-based withdrawal planning, starting conservatively and then building flexibility as you go, is the actual tool for managing some of the sequence risk. This is less glamorous than the other strategies, but I think actually it's the most important. If you have a financial plan, a real one, by the way, built around your actual spending needs, your income sources, your timeline, and your risk tolerance, then a 20% market correction does not change your plan. The plan is actually already accounted for the market decline. The question in a downturn is not, what do I do today? It's, does this change my 20-year trajectory? Most of the time, with a well-constructed plan, the honest answer is no. The problem is that most people don't have that kind of plan in front of them when the market drops. They have a brokerage account and a vague sense of what they're trying to do, so that when volatility hits, there's nothing concrete to hold on to. There's no anchor, and the emotional response now that you have is filling that vacuum. If there's one thing that I'd encourage you to do after watching this video, it is to make sure that you have a written plan that you've stress tested across a range of market scenarios, not a plan built around average returns. A plan that explicitly asks, what happens if the first 2 years of my retirement look like 2008? If you have a financial plan that survives that question, you are in a much better position to stay the course when the markets start to test you. I want to land this plane the right way because I know some of what I've said today can feel uncomfortable. Because yes, the historical record is clear. Yes, the behavioral research tells us that panic selling is almost always a mistake. And yes, the math of missing the best days and the data on investor performance is alarming. But I also want to acknowledge that staying the course when your portfolio is down significantly is not an easy thing to do. It is not supposed to be easy because the discomfort that you're feeling and the loss aversion is real. The fear that this time might actually be different is real to you. What I'm asking you to do is not to feel nothing, it's to build the kind of plan and the kind of structure, maybe it's a cash buffer, a written retirement income strategy, a thoughtful approach to guaranteed income that lets you hold your course even when everything in your nervous system is telling you to run. Emotions during a market downturn are data points. They are not instructions for you. The evidence across more than a century of market history, across the academic research on withdrawal rates, across the behavioral science on investor decision-making, consistently points in one direction. The people who stay invested, who have structural buffers in place, and who make a decision from a plan rather than fear tend to come out dramatically ahead. If you watch this video and you're genuinely not sure whether your current plan is built to handle a downturn, that is useful information to you, and it is not a reason to panic. It's a reason to work on it. And if you're in that retirement red zone right now, roughly ages 55 to 70, and you want to talk through how your specific situation stacks up, there is a link in the description to book a free introductory conversation with me. There's no pressure, it's just an introduction. Just a real conversation about whether your plan is built for your retirement. I'd love for you to hit subscribe if this was useful to you. I put out new content every week for people navigating those years immediately before and after retirement. So I'd love to see you in the next one. Stay well. Bye-bye.